Now, if you go back in time and you consider crude oil, um, it's a pretty old industry, um, dating back to the 1800s and uh, the Industrial Revolution. It quite literally fueled that, right? But outside the fact that if you look at a large three waves back here in crude oil, um, that if you look at this from a logarithmic scale, it's going to pull this in just a little bit, and it will probably put that equal legs down around, anywhere between $10 to $30 a barrel. Now, outside the fact that you're trading in a large three-wave pullback that, by the way, has made new lows, and because it's made new lows now, would be considered, or should be considered, complete. A three-way structure down in a correction for oil. But there's an important area here that held before, and it's this 30 handle and the prior lows here for crude. And there's a reason the 30 handle held as support. For starters, as oil started getting ratcheted back up, the price of oil off of the recession low, the all-important $60 a barrel level became a major support. This is an area in the market where nations like Brazil and Russia assumed the price of oil would be above when budgeting their fiscal year. It also happens to be the break-even point for most oil rigs and oil shale production. So we need oil to be above $60 a barrel to keep certain pumps even running. And that's everything from an oil rig to even nat gas production. Nat gas is kind of just a byproduct of oil production, but either way, as you started to slip below the 60 handle, it naturally found it as resistance, coming back as a test. And the market has now traded down into the all-important 30 handle. This is where we start entering the break-even points of some of the older players in the oil game, stretching down to about $10 a barrel, on the low end of that spectrum. So this is your old timer, the titans that built this industry, break-even support area. For even some of the oldest oil wells, they still have a cost associated with pulling that oil out of the ground, and it's as low as $10 a barrel and as high as $30. This is a key area in the market. It's a very big area, but it's a key area in the market to understand in terms of supply and demand and the way a cash and carry trade works. In other words, there's a carry associated with crude. It costs money to hold crude, physical crude, whether it's in a silo or however crude's stored on a tanker, wherever you decide to store your crude once you own it or pump it out of the ground, costs you something. And at a certain point, it makes more sense to, instead of buy your crude effectively from the ground, or the cost associated with pulling it out, to meet the demand that you are obligated to meet, because companies like Shell and BP, all of those big oil conglomerates, it's the only one that's coming to mind at this point in time. But it doesn't matter. The point is that if you're in the oil production game and it costs you $30 a barrel to effectively turn on the faucet from the ground and pull your oil that you have rights to out of the ground, it makes more sense to leave it in the ground where there's no cost associated with pulling it out and start buying oil off the open market to meet your demand obligations to whomever you supply. So when oil failed to break above this 60 handle, or this key break-even point that was used for things like the national budget of Brazil, that is effectively the squeeze and price discovery, knowing that there's a big resistance level there. Somebody's going to get squeezed lower. And now we're hitting down into this area where, yes, we've had downside targets from shorts. Yes, there's next in series setups that can take us lower. But the second they start to break, we are into a support level that could easily take crude back up into, well, I don't know, maybe just 50 back of the prior decline. That's still all the way up to a $90 a barrel area. So at some point this will bounce. And ideally, it's because of this interesting $30 to $10 range where you actually start seeing it become more fiscally responsible for oil producers to pull oil off the market than out of the ground, because it's cheaper to leave it in the ground at that point. And that's kind of the $64,000 question, or the $1 million question, is where precisely is that level going to be? So it's interesting how oil may end up becoming somewhat snug here between what is otherwise a level that keeps oil in the ground rather than coming out of it. And I'm willing to bet that we may have some bigger range here that forms for an extended period of time. And this is just purely off of the idea that this is the zone between where it doesn't make sense for oil to go below. It just economically does not make sense. Like, there will be support here from the industry itself. And then you have this kind of area that's getting squeezed of nations that have otherwise maybe tried to move away from typical national forms of finance. If you're not taking out debt with the IMF, you're parlaying your commodities. And this is a squeeze on nations trying to do that. It's interesting. Absolutely, Stephen. If you can't sell your commodities to meet fiscal obligations, you keep people in debt. And playing the currency game. Because that's what currencies are all about. Currencies are really about people valuing what debt is worth. If your currency is not worth anything, it means people don't value basically your long-term bonds. They don't believe that you'll pay back or that the currency that you're going to have to print to meet those bond obligations is worth anything at that point in time. Because as long as somebody still wants it, as long as there's demand for a currency, like people still want to hold it, then you're fine. You can print as much debt as you want. And that's why in places like Brazil, in Argentina, you're seeing inflation. Real price inflation, that because of currencies that aren't allowed to fluctuate, because of all these number of reasons, people hoarding physical goods because they're afraid their currency will be devalued so rapidly that they have to hold a physical good just to make up for that loss. And that's